Welcome, subscribers, to the Saturday Summary for October 11th, 2014, your weekly summary of market and economic news for annuity and life insurance professionals. I'm Jonathan Illig of Brokers Alliance here for The Biz. Well, the last 2 weeks have been a bloodbath for the broad indices. Last week's decline were followed by the worst week for stocks in 3 years, with the S&P 500 dropping another 2.7% and the Dow losing all of 2014 gains with a weekly decline of 2.45%. The small caps also got hammered. The NASDAQ declined by 4.45% this week, while the beleaguered Russell 2000 Index went down by another 4.65%. Now, looking at the past 2 weeks is even uglier. S&P down 3.8%, Dow declining by 3.3%, the NASDAQ by 5.23%, and the Russell 2000 losing close to 6% since September 26th. Overseas, the EuroStoxx 50 index has declined over 7% in the last 2 weeks. This week also saw the volatility index, or the VIX, jump by 40%. Thus, this week's headline, Approaching Storm. Now, it's only a possible approaching storm and not the storm. Not yet. With the exception of the Russell 2000 Index, the losses to date do not yet qualify as an official correction, which is typically defined as a decline of at least 10%. And it's certainly not yet anything approaching a bear market, defined as a decline of at least 20%. Nonetheless, this may be the start of a long-predicted and long-awaited reversion in the equity markets. The signals are all there. To use this week's storm analogy, the barometer is falling rapidly. Well, adding to the winds, the yield on the benchmark U.S. 10-year Treasury Note closed Friday at 2.3%, a decrease of almost 25% year-to-date and over 14% down since this date last year. Now, this reflects continued demand for safety and the scarcity of these Treasury bonds due to Federal Reserve buying of U.S. debt for years under the quantitative easing program. We see ridiculously low yields on other sovereign bonds as well as corporates and junk bonds. We talked a lot about that in the last couple of weeks. Well, this plays right into one of our quotes of the week. This is by Econ Matters Team blog, who wrote, quote, "How did my parents' generation ever survive with a 4% federal funds rate? The Fed has become the local crack dealer for the financial markets," end quote. With a net result of this, as the equity market bubble appears to have begun deflating at least a little bit, this week saw the bond bubble inflate a bit more. None of this is going to end well. Now, speaking of the Fed, the minutes of the FOMC, that's the group that sets rates, were released this week, and they contained language that was interpreted as, quote, dovish. That means continued low interest rate sentiment within the committee. Well, this caused a rally on Wednesday, with the S&P 500 gaining 1.75% after that release. Of course, this was either a sucker's rally or a dead cat bounce, for as we know, the index then fell over 3% the following 2 days. Now, of more interest in the Fed minutes, it was revealed that the members did not want to change what's called forward guidance language. This is kind of telling the markets where they think interest rates are going to go. And they didn't want to because they were afraid it would spook the markets. My question is, where is that mandate in their charter to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates? Where's Dorothy with a quick slap? Well, what's the view of our wealth manager friends and colleagues over at Gebhardt Group and 401k Masters? Well, at market close, we caught up with Matt Richmond, co-founder and chief marketing officer for 401k Masters and a wealth advisor with Gebhardt Group. Matt's on the road. Let's see what Matt had to say.
Hi, John. Thanks for having us again on this week's Saturday Summary. I couldn't agree with you more about your theme this week of kind of a shift in the markets and that a storm is really brewing. We really sense this storm ourselves. In fact, we go back to October 1st when our primary indicators at the Gebhardt Group indicated a trend reversal for us. We actually advised our clients at that point to take a much more defensive position and actually saw clients repositioning assets into what we call protect mode or a defense mode, where they wound up being anywhere between 40 and 75% in cash. You know, I can't help but watching this turbulence in the market and really think back to some of the scariest airplane flights I've ever taken in my life. So it's kind of apropos that here I am today reporting to you and your viewers on the Saturday Summary from a hotel right next to O'Hare International Airport. There's one flight in particular that really stands out, and it was one I took with my wife and my newborn son 14 years ago on our way home from my brother's wedding. It was probably the bumpiest flight I can ever remember being on. I had a newborn son on my lap screaming the whole flight. I had a wife sitting next to me who was sicker than sick. And all we were told to do was sit still, buckle our seatbelts, and hope that we might get to our destination at some point safely. By the time we got off that plane, I was incredibly frustrated because I really felt a sense that the pilots had just stuck us on autopilot and just charged through the storm of the century, in effect. Why didn't these guys just adjust the altitude? Or better yet, why didn't they even think about putting the plane on the ground? Because at least then we could have gotten up and stretched our legs and quieted down this screaming baby of ours and at least had some relief from all the bouncing around. The reason I share that with our viewers today is because I imagine so many investors are feeling that way with all the turbulence that we're seeing in the markets, with volatility back to levels that we haven't seen since the fourth quarter of 2011. These are new old feelings kind of coming back to us again, this volatility, this bumpiness, this turbulence. And if investors are having the kinds of flashbacks that I've recently have about some of the bumpy flights I've taken in the course of my career, then maybe it's time to consider not just flying our retirement savings on autopilot, hoping to reach our destination safely one day. As I mentioned earlier in my report, our wealth management clients are nice and safely sitting at a different altitude at this point, anywhere from 40 to 70% in what we call protect mode. Now, I encourage our viewers to consider getting off autopilot and seeking the expert guidance that airline pilots have, because this isn't an easy game. This isn't something that we can just take a gut feeling or an emotion and make a decision on. That's some pretty dangerous business. So I recommend that our viewers seek out some expert guidance that relies on very sophisticated instrument panels and indicators to help them adjust their altitude. At the end of the day, if we're getting sick and tired of this turbulence, we can't just sit still and be quiet hoping we get to our destination safely. We need to do something about it. So, reporting to you from O'Hare International Airport, one of the busiest airports on Earth, I'm Matthew Richmond. Back to you, John.
Well said, Matt, and from your mouth to God's ears. Well, there is good news to report this week. Clients who reposition some of their retirement savings to a fixed indexed annuity will sleep peacefully this weekend and for the days to come, because in the past 2 weeks and the weeks to come, the equity market losses have not decreased their account values at all. They know their money is protected from market loss and that their lifetime income guarantee has not declined at all. For many of those whose annuity accounts are allocated to one of several volatility-controlled managed indices available in selected products, as this storm unfolds in the coming months, they will not only be protected from the downside, all fixed indexed annuities do that, but they also have the potential to earn interest in an environment where the broad equity indices are falling or flat. At Brokers Alliance, we are experts in helping our producer clients properly position these defensive risk management tools for their clients, and we'd like to help you too. Call Aaron, Lewis, or Nate to find out more about volatility-controlled indices and how to learn about our unique IFL Income for Life using Guaranteed Annuities Retirement Income Planning Support Program. Well, that's your Saturday summary. Be sure and read the written summary. It's chock full this week. Have a great weekend. We'll see you next Saturday.